point in time, we're going to hear about hotel financing, a 30,000-foot view. Please welcome to the stage Mark Gerstein, Vice President, Capital Investments and Transactions at IHG, and his panel.
I said Vice President?
I think you're going up.
Okay. No,
He's right.
That's
Mark's right.
yeah.
It's a game show.
We'll figure it out where everyone sits here. Okay. Good morning. I'm delighted for all of you to join us this morning for hotel financing, the 30,000-foot view. My name is Mark Gerstein. I'm Vice President of Capital Investments and Transactions at IHG, and I've been with IHG for over 5 years. Previously, I was a banker at Morgan Stanley and UBS. We have a compelling agenda today for all of you here. We're going to cover a few topics. First, I'll introduce our panelists. Then we'll talk about financing stabilized hotels. We'll turn to financing hotels that are having a major PIP or renovation associated with it. Then we'll cover new construction financing. We'll talk about buying or selling in the current market. And then we'll end off with some macro view perspectives here of where the economy is heading, where's interest rates heading, and cap rates, supply. So with that, I'd like to introduce the panelists. I'll start at my far left with Jon Wright. So Jon is the president, is the CEO and chairman of Axis Point Financial. Axis Point Financial is a direct lender, servicer, and advisory firm. Since it was founding in 2011, he's originated 650 loans with $3.5 billion of asset value, and the principals at Axis Point over their career have done over $10 billion of deals. Next to Jon is Adi Bhoopathy. Adi is a principal and executive vice president at Noble Investment Group. He's responsible for capital markets, for asset management, and for transactions. He has over 19 years of experience, and Noble is a private equity firm that invests in both opportunistic value add and income producing upscale select service assets with the major brands Marriott, Hilton, IHG, and Hyatt. And he has, Noble's invested in over $3 billion of deals since its inception in 1993. Next to Adi is Arvind Bajai. Arvind is a senior banker at Morgan Stanley in their commercial mortgage real estate group. Morgan Stanley last year originated $16 billion of commercial mortgages, and Arvind has been with Morgan Stanley since 1997, and he did a previous stint, that's actually when I worked with Arvind, for 10 years as well. He previously was with Credit Suisse, with Blackstone, with their Park Hill Group, and with Madison Marquette, so he's got both principal and lending experience. And to my immediate left is Scott Andrews. He's a managing director at Wells Fargo in their hotel franchise finance group. He's been spearheading and being the team leader of growing that business. It's a new business that he'll talk about. It's been operating for about 1.5 years now, and previously headed up originations at GE Capital Hotel Franchise Finance and at Western Alliance Bank. So we'll start off with financing stabilized hotels. I'll turn it to Arvind to give us a perspective of where is the CMBS market, what are typical terms that you see in the market right now, and both for fixed and floating.
Thanks, Mark. Look, I would say that to start out with, the CMBS market is very robust right now. It's credit markets are very benign. There's a calmness in the credit markets, despite a lot of volatility in the world, you could argue, internationally, politically. And surprisingly, CMBS spreads and demand for CMBS loans are very steady. Just a quick history. Right before the crisis, the CMBS market peaked in the U.S. about $230 billion. 2 years later, 2009, it went down to basically zero, $2 billion. And $2 or $3 billion. Now it's come back to being kind of about an $80 billion a year business, and it's very competitive. Okay, getting loans, finding quality loans as a lender is very competitive, and for borrowers in the audience that helps you tremendously, obviously. just like it's tough to find good quality assets, it's tough to find good loans to make. And so I think right now what we're seeing is that we were joking around about this at one of the events last night, that it used to be that retail was the, there was retail was versus hospitality, and hospitality was, let's say, a less desirable asset class. And I think hospitality has certainly surpassed retail as a desirable asset class. And we are currently lending probably about 10 to 15% of our volume is in hospitality, and which is consistent with what it is in CMBS. And So
Arvind, where would you do a 10-year loan today? For 10-year, what's the LTV and what's the rate?
10-year LTV, I mean, officially it's 65% loan to value, but I'd say realistically it goes 65% loan to value up to 72% loan to value is what it is for hospitality. Acquisitions, you can do better. And there's a tremendous bias towards acquisitions versus refinancings.
And what's the rate?
The rates are swaps plus anywhere from 175 to 225, I'd say.
That works all in?
And so as of this morning, we're talking about this, the 10-year swap is below 2.5%, okay? 247, 245, call it. Which is 60, 70 basis points below where it was like during the election, okay? So it's 2.5 plus, let's say 2, so 4.5 to 4.75% rates are doable right now.
All right, so very, very competitive financing
very competitive
in terms of long-term where rates are, to the way 10-year at that. So Scott, just turning it to you here, how would you compete in terms of, maybe give an overview for stabilized hotels, what type of terms that you provide to borrowers, and how do you compete against the 10-year at 4.5 to 4.75?
Sure. So CMBS is obviously a very good vehicle to finance long-term permanent assets. Wells Fargo Commercial Real Estate Group has its own CMBS execution. Obviously, that's a product that that the bank offers. Our group really is a pure balance sheet lender, and I would say we compete with CMBS. We're not a non-recourse balance sheet lender, so that kind of checks the first box. And then secondarily, on the interest rate, our rates are pretty much right on top of where the 10-year would be, but we have a 7-year fixed rate product at roughly in that, call it 4.5, 4.75 range. But the difference probably between the CMBS and balance sheet is just the flexibility of having a balance sheet lender, having a direct relationship, and not necessarily having to call a servicer when you have issues with your loan down the road, if you do have issues. And that flexibility really comes in the way of if you want to sell your asset within the term of your loan, we have flexible prepayment penalties. If you want to top off your loan at some point, if the asset continues to ramp up, we're open to doing that. And then just flexibility in terms of how we handle reserves. But it's like I said, both are really good vehicles. It just depends if you know you're kind of at your top valuation and you want the 10-year non-recourse CMBS deal. That's a great vehicle. If you want some flexibility but very close to what the CMBS is offering, and you'd rather do a balance sheet deal, with a lender like Wells Fargo, that's really how we compete, kind of head-to-head on that standpoint.
All right, Addie, as a borrower here, how do you think through financing your assets between CMBS, a balance sheet lender, you've got insurance companies out there lending competitively, there's other debt funds out there. How do you think through the different types of sources for stabilized?
First of all, good morning. Thanks for being here. And I just want to let you guys know I lost a bet with Mark on the over-under on the amount of people that will be at this event. So I was off by a lot. So thank you.
They all wanted to hear you, that's why. So.
That's nice. It's in a good place when you have, there's no shortage of debt capital out there. I mean, you're in a very good place. I mean, we've had a pretty good run for a good number of years, and there's this good capital out there between CMBS and balance sheet insurance. So there's no shortage of capital, especially with a quality sponsor. I think the availability is very much out there. I think it just depends on your business plan. I mean, we have 2 buckets that we invest through. The value add side, where we do our ground up and major repositioning. I mean, those are very middle of the fairway for floating rate bank type of debt. Kind of 3 to 5 year timelines. And then the in-place income vehicle that we invest for, we underwrite to a kind of 8 to 10 year average hold period, and that lends itself to a wide swath offerings. So I think our view is more a portfolio view of it. So we'll have probably around 60 to 65% of the overall portfolio in a fixed rate, probably a CMBS or an insurance company, 7+ years, kind of give you some flexibility on the back end, so you can not have to time it perfectly, so you have some exit capabilities. But with Scott's balance sheet, I mean, you could get 7-year float and hedge a little bit of the market risk and probably have 30-35% of your portfolio with a floating rate bias.
Okay. So Jon, turning to you here, you have a new ownership for a little over a year now. If you could give an overview, how's that impacted your ability to originate loans? And we'll get into your terms in the next section here, but maybe just overall volume. How's it?
Thank you, Mark, and Hunters. Thank you for hosting again this year's successful event. Addie, thank you for staying for the panel today, because Mark and I also had a bet that I heard you won the $1,000 drawing and that you took your money and just went home. So I'm glad
I'll spend it later.
Stayed put. We were indeed acquired a little over a year ago. Our group, we had been funded previously by a private equity group out of Greenwich and had invested $400 million of equity into our business back in 2011 after we sold our portfolio to Blackstone. Our private equity group is more geared to incubation of especially finance type companies like ours and across different asset classes. They were the first investor in auction.com and a number of other institutions you would know of in XT, General Commercial Finance Group. And they had a hold position for our team up to 7 years. We were fortunate enough to have the Kuwaiti government pension fund. If you want to talk about a niche investment, it's a stretch from where I grew up, but we have successfully recapitalized, like I said, a little over a year ago. We are geared with our new partners to fund. We've targeted $1 billion a year of bridge financing. Those of you that know us, we're a direct lender. And we closed roughly 125 transactions last year, which is in line with our typical annual production in good times or bad. Cost of capital at private equity, of course, is a bit more expensive than my friend Scott down the way here at Wells Fargo. We don't borrow at Fed funds, and therefore we are basing off a cost of capital 500-600 basis points minimum more expensive than the banks, and therefore our products are geared to drive yield, seeking yield from the private equity as well as our executive team, who are also investors in the company, obviously. And so we have today, Mark, we're lending in the construction space. It's been a quiet product for us up till now, and we're getting ready to roll out a much larger presence in the construction space. And we have been successful in achieving our target ROEs in low teens. 12-13% is where we have delivered over time on average through the years on balance sheet or through private equity. But our focus and our niche and our specialty, whatever you view it, on the bridge lending is for repositioning of underperforming assets, and we will take a view 24 to 36 months out post-renovation on the cash flow, so that we will look to have 20-30% of equity on a cost basis into the transactions, but we are providing an IO strip out to 18-24 months. That typically will provide enough time to complete a renovation on a larger scale. And the average term of our loans is 5 years, average amortization is 20, but the average life is 1.94 as of this morning. So that is truly bridge. We're getting taken out at 1.94 years.
All right, so John, we'll get back to the terms in a minute here when we get to refinancing here, but I'd like to turn it now to...
He's interrupting me again like last
Well, we got a lot to cover here, so wait a minute.
I've got to get my shot when I can. Thank you, Mark.
So Scott, could you
Thanks very much.
to talk about where one of the themes we've been hearing about is creeping expenses going on in the hotel field, labor costs getting higher here. How do you think about underwritten NOI when you're looking at a loan in terms of loan sizing?
So first of all, as that's my group said, it's a very robust refinance market, acquisition market. But having said that, I mean, we're very much cognizant of a couple things: new supply that's going to impact our existing portfolio and any new deals that we put on the books. So we're kind of underwriting to the impact of that new supply from a top line perspective, but then also, the impact of increasing labor costs, real estate taxes are going up. So if we're sizing a deal today on call it a 12 debt yield in a secondary market, we want to feel comfortable there's call it a 2% RevPAR growth, over the next few years that can help mitigate some of the expense creep, if you will. So, but it's definitely, our underwriters definitely look at that fairly closely. Certainly the appraisal reports that we get in are starting to include those increased expenses that you guys are having to endure. So it's real. But like I said, it's still a healthy general economy, and there's not a lot of change in terms of where we're sizing deals.
So what debt yields or what level?
So call it a select service extended stay asset in a secondary market. We'd like to kind of be at a 12 debt yield. If we move into call it a top 10 or a coastal one of the coastal markets, call it a 10 to 11 debt yield. So obviously we have the ability to go a little bit lower in those bigger, more diverse markets.
Okay, and Addie, are you seeing a change in how loan sizing, underwritten debt yields are today versus where it was a year ago?
They've been generally still consistent. I think they have not compressed further. I think the spreads have held up and the sizing has been generally consistent. I think they are a lot more granular. I mean, it's the macro is what it is. I think it's a pretty baseline expectation for the next few years. So it truly is the micro and the product, deal specific underwriting clearly. But I think the going in debt yields have generally been still consistent over the last year.
Yeah, one thing, Mark, that has changed, at least in CMBS in general, I think, is that its market is moving from 25-year AM to 30-year AM on a selective basis on newer assets coming off PIPs, which obviously is a big pickup for cash flow.
Yeah.
Hey, Addie, back to Mark's question. As the owner, how do you guys look at the expense creep when you're doing your forecast? How do you look at the impact of new supply on an acquisition, or even just assessing your current portfolio?
I think, listen, if you're looking at the number one focus, I mean, it's clearly an operations intensive business, so the labor side of it, and it's not just the cost creep around it, it's just the availability of labor is, it's a twofold exercise that is front and center for everybody. And it's coming. I mean, there's obviously a lot of markets that have already moved up the minimum wages and to a point that is meaningfully higher than what was already in place. And so the key is to still find some markets that have more than the 2% growth projected. I mean, obviously Atlanta, we're biased about it, but it certainly has all the dynamics of a marketplace that is poised to outperform the base case macro 2%. So find those type of markets to have a revenue spectrum a little higher than the expense creep at this point. So I mean, a lot of the markets you were already paying about the minimum wage requirements, and so it wasn't dramatically increasing, but it's clearly in front and center for everybody right now.
Okay, last question on stabilized hotels, and we'll move to renovation. So Arvind, you financed the Crowne Plaza with your private bank here a few months ago. Maybe talk about what the terms look like at the private bank, given it's different than CMBS. So.
Yeah, so again, my group is the balance sheet and CMBS group, but we also lend out of our private bank, and most investment banks have these different private banking programs that are, number one, very geared towards how much assets you have. If you're a private banker or a client that has different levels, 2 million, 5 million different assets, the more assets you get, the better terms you get. Number two, they're generally recourse, not always, but they're generally recourse. And in this case, I'd say the base case, it's usually a 3-1-1, 3-year, they're floating rate for the most part, 3-year term with a 1-year extension, or two 1-year extensions is kind of the thing. But it's very tailored. In fact, the program is called the Tailored Lending Program because it's very much customized.
Okay, so interest rates in that
Interest
area?
rates are LIBOR plus 150 to LIBOR plus 200.
So very, very competitive cost
Yeah,
of
they're
capital.
very competitive.
But generally lower leverage, right?
Generally lower leverage, and I mean, candidly, and they're not, hospitality is not their favorite asset class on that side. But again, the more assets that the customer has with the bank, I mean, there's a big push by all the banks to gather assets. All the private banks, a big theme.
Yeah.
And so the more assets you have, the more.
Yeah, I just want to bring it up because there's different niches of capital out there to go take a look at.
You mentioned earlier that the CMBS market is biased towards acquisition versus refinance. What's driving that?
Yeah, and that's obviously not just hospitality. It's all asset classes, and it's concerned where we are in the cycle and values, and refinancing in terms of sponsors pulling their cash out. So new acquisition by definition, you're market to market, and so that's where I think things are creeping from 65 to high 60s or 70% acquisition.
Okay.
So, and it's a way to find assets and to be more kind of justify ourselves being more aggressive on assets.
Okay.
Okay, so John, turning to you, renovation of hotels, financing. You guys have a little bit higher cost of capital you were mentioning before. What's your terms look like? I know you break your loans out a lot of times into a mortgage and an FF&E loan. If you could talk to the audience about that in terms of two different pockets of capital.
I just want to be clear, though, first. It says I have 36 minutes. Is that right?
Yeah.
Is that correct? Okay. Good, then I'll take my time.
I think these three guys would be upset.
Let me take my
I
time.
think there's a shot clock, isn't there?
I thought it was, yeah. That was my Bruins from Belmont lost. But anyway, thanks again, Mark. What is called a bifurcation loan in our shop, whereby we will break out the land and building and advance the proceeds against that collateral, and then we put a hyper amortization on the CapEx component. It's really unknown to our clients in a sense that it's an interest-only period during your renovation. Today, our rates will be in the range from 6 to 12%, but we're everywhere in the capital stack. So on a blended basis, we're going to be much less expensive than traditional mezz and other bridge-type financing vehicles. In the senior, in the A tranche, we're going to be 200 to 300 basis points more expensive than a bank lender. But on a blended return, a blended rate, we're going to be very competitive based on the fact that our B tranche is far less expensive at the 12% range for the mezz debt. The bifurcation is a traditional senior loan, and then with the carve-off of the CapEx component, the hyper amortization matches the useful life of the equipment that you're using for the renovation. What that basically does is pair up our ability to match our private equity in every transaction with our leverage partners at JP Morgan and at KeyBank that come in and provide a much lower cost of debt. And so we have been very successful with that product. And again, unstabilized, it is 24 to 36 months that we're looking for out on our underwriting on the proceeds basis.
Okay.
John,
Thanks,
are those are recourse loans? Also?
Yeah, they are recourse. We will have a burn off because we're not going to be at all competitive, nor do we quote transactions. We're not asked to for stabilized cash flow, and so we're coming in on acquisitions that are changing a flag, that are south of break even. And so we're looking for personal or the management company recourse, but that will burn off at break even, and then a 125 debt service coverage we'll burn that off totally.
Yeah, John's been very helpful for IHG franchisees over the years in terms of financing some of these changes.
Thank you, Mark. I appreciate it.
Have to make up for his interruption.
We've made up now, officially.
Arvind, if you could talk about CMBS and its ability to finance major renovations. How big of a renovation works in CMBS? When is it too much? Could you change the flag? And what's the impact on pricing?
Yeah, I mean, look, I think it's CMBS is not the best for renovations, frankly. I mean, it's just a short answer, cut to the chase. I mean, I think the rule of thumb is when you close it, when you're at acquisition, kind of you'd want a maximum PIP to be 20% of the loan amount. Okay, can we get to 25%? Have we seen 30% yet? But that's, that's pushing the envelope, frankly. And so that's up front. Then on a going forward basis, when there's the kind of structure is if there's a franchise maturity in year 6, there's some sort of sweep amount, some sort of cash flow collection amount that needs to be put in place, 12 months prior to have it. And look, we work with the sponsor to estimate what that should be. But look, I think the pros of ours, you get a lot of leverage, non-recourse, but there's probably other vehicles,
Could you change the flag when
changing the flag is very difficult, frankly. It can be done, but it's tough to it's tough to pre-wire the ability to do that because you're going to say, well, how do you know you're going to change the flag in year 5, year 6?
Mark, and that's what we see as I referenced earlier, nearly 2 years is the average timeline before we're taken out. And we had 300 prepayments roughly in the last 24 months before year 5 of full term. And CMBS has been very active. Everything from good brokerage coming in at PMZ, bringing in to take out on CMBS, and all the way to we had NASA Federal Credit Union take us out on the transaction recently, and Mass Mutual, a few life companies that are very active. But it's obviously for stabilized assets. It's been a very very busy market and very effective.
So, Scott, could you talk about, in terms of financing hotels with major PIPs, what works in your program, and
Sure.
Is there anything that's too much of a PIP?
Yeah, so the group that I manage really focuses on the middle market segment of the U.S., and we're mostly doing stabilized assets. It's acquisitions and refinances. We will do PIPs associated with the refinance. Generally, that's going to be a total recapitalization of the debt, and then your typical brand-mandated PIPs that come along with an acquisition. So nothing hugely major as far as that goes. We're typically 65%. Our borrowers will put their 35% of purchase price and the PIP in first, and then we'll obviously fund our portion of the PIP on the back end of it. Our sister company, there's some members in the audience as well, that's part of our commercial real estate group, hospitality finance group. They basically handle larger institutional clients, bigger assets. Noble's one of their customers. Very, very good at doing large TI, tenant improvement transactions, typically 60-65% LTV or LTC, full completion guarantees. They'll get a sweep, during the renovation period, and structure of that deal kind of appropriately. Those deals are done, I think, very selectively. Borrowers that have really good experience going in and doing these heavy renovations. Same with on the construction side. So while they have that product, it's fairly selective.
Okay, so bringing some real-life examples here, Addie, if you could talk about how you finance the Residence Inn in Denver and the Hilton Garden Inn that you recently acquired in Perimeter. How did you go about doing those acquisitions that have PIPs associated with them?
Yeah, I think the Hilton Garden and Perimeter was it's in a value add fund. It had multiple, while the brand was going to be the same, we had a full renovation that needed to get done from a brand change, change of ownership PIP, and along with the management change. So there was clearly a value add timeline to it. So it was a balance sheet loan. I mean, to the earlier point about how CMBS is not the right vehicle for any of these PIPs, I think the key for any financing is to get your business plan match the lender. I mean, try to force just because it's slightly better or you're getting something around the margins to force the product that doesn't fit what it's intended to be is, especially in this cycle, kind of late cycle where we are, it's a good recipe for finding yourself in uncomfortable place in a few years. So I think, and especially if it's a harder, bigger conversion type of stuff, you want to stay with your known banks, your kind of regional banks and the like, where things will come up. I mean, sometimes the conversions are a lot harder than the ground ups. I mean, there's a lot more things to work through. But
so those two deals, they were with regional banks then? What was it, leverage levels?
The Hilton Garden Inn was a bank, and the Residence Inn was a unique place where we bifurcated the hotel and the parking deck. It had an oversized, over 400 space parking deck that clearly was not needed for the need for the hotel. So that was the bifurcation of kind of condo to unit out, and we did the hotel as a CMBS and put the deck on a balance sheet with the mindset to exit in a short timeline over the next 12 months.
Interesting. So you use different products in different situations. Turning to new construction, John, you were mentioning you're going to be rolling out a new product. Could you give us any parameters of what that's going to look like in your existing new construction financing product?
Yeah, sure. Our projects typically resemble new construction for the most part because they involve major renovations and repositionings and a conversion with a new flag, as Addie referenced. And we agree, ground up is most oftentimes far less surprises than major renovation and conversion. As a lender, we have much more control and follow the budget, and more than anything else, keep up with any attempts of bad boy behavior. I hate to reference that, but we occasionally bump into that. But yeah, we had a project, for example, at Grant Park, dual branded Hilton, right at Grant Park, $125 million project. And it was one of our first clients from 25 years ago. We were able to refinance. Now, this is an example of a stabilized asset that we refinanced in Evanston, right next to Northwestern's campus, for the same client, obviously, and we were able to take the equity out of that very stabilized asset, good performance, about a 150 cover, and transfer that equity over to the new construction project at Grant Park. We had EB5 involved with that as well, and another boutique hotel owned in close proximity to the Grant Park location that we also were able to take a second mortgage on that asset to exploit the equity that was in that boutique hotel. So that's the creativity that's coming to the table today. And I was just thinking too, on these prepays, we actually had Wells, Scott's team took us out on 3 or 4 deals this last year. So very, as you all know, very incestuous industry that we live and work in. And so even if some folks on the stage, us included obviously, are not going to meet your needs, it's just easy to make a phone call and we can refer that business. We're happy to back and forth.
So John, will you guys be doing just straight up standalone construction financing?
Yeah.
Okay.
Mm-hmm. Yeah,
what's the leverage levels going to look like for that?
Yeah, it's with key money or brand enhancements, which in the past we've had plenty of opportunities to pick and choose and diversify and stratify our geographic footprint and to diversify our risk. But it's 65%, 70 max is where we see, because we can escrow the key money that's offered up by the brands to the developer, and then we'll release the key money or other inducements at CO.
Okay, and what's your rough pricing going to look like?
About 6% today.
6%, okay.
Whatever indices you want to use, but it's a 6% handle today floating. Okay. And it will come in and put a cap or a hedge and some type of collar on that, and ensure the risk is limited.
Right. Well, we look forward to hearing more as you roll this out. Addie, you recently opened the AC and Moxie in Midtown Atlanta. Could you talk about that, given that was new construction? How did you finance that deal?
Yeah, the AC Moxie, we built it ground up. For those of you who have not seen it, you should go look at it. We're very proud of it. We opened it a couple of weeks before the Super Bowl, so the management team is obviously happy. They can't complain about ramp up. Certainly, we couldn't give them a better run rate with the brand new product and a Super Bowl. So it hopefully only goes up from there. But it was, certainly a very complicated deal in the sense that it was service parking lot owned by a public parking REIT. So we kind of had a structured deal where we maintained their cash flow during the construction period, and then built a deck and the hotel on top, and condoed out the deck and the hotel pieces upon completion. Given those moving pieces and in general construction and our view towards it being more regional bank focused, we've used Synovus as the lender for it, and it was a 65% loan to cost and a great execution. So, and since we're talking about banks, the other deals were Western Alliance and Wells Fargo. So whoever is out there, good banks.
Well, it's helpful to hear who's active. So, Scott, if you could talk about, you have an interesting construction takeout loan, which sometimes is interesting because we view as there's a bunch of these community banks out there who, if you could kind of take them out, then they could do your next construction loan.
Sure.
So having that out there, what does those loans look like?
Yeah, so our group actually has credit authority to do ground up construction. Frankly, we're just choosing not to do it at this point, and just really focusing on more on the stabilized assets and takeout product, which is what Mark just offered here. There's a number of lenders still doing ground up construction. I probably met with, I don't know how many borrowers, but a lot of them had pipelines, deals in construction, so the people are still getting construction financed. We have a pretty unique takeout product. We can take out a construction lender at C of O or shortly thereafter. We'll typically get 25 to 50% recourse, and for some of the community banks, that's taking you from 100% recourse down to call it 25% at that point. Put it on a 7-year term for you, interest-only component, maybe 12 to 24 months because the property it's in its ramp-up phase. So typically we're going to look at actual cost, what it costs you to build it. But in some instances we can be at call it 65% loan to value, 70% of cost. And we're doing that relatively selectively. So we're looking for operators that have a proven track record of building, ramping up, and stabilizing property. So we're not really offering that product for anybody's first construction loan. So we really deal with a little bit more seasoned borrowers. But it's a great vehicle. So to Addie's point, there's a lot of banks out there like Synovus. Is that who you mentioned that did that? So that type of bank and debt funds and John's company that are doing construction financing out there. So and then if you want to free up that capability, if you need to free up that capability, because a lot of the smaller lenders kind of reach a ceiling, and frankly they would prefer to do construction financing and get the fee income out of it.
And for the audience, what's the rough rate on those, and how does that compare to stabilized assets?
Our stabilized, call it low twos over the indexes, and we'd probably bump that 25, 50 basis points just because it's unstabilized.
And Scott, you all are, we saw last year when I mentioned you took us out of a couple of assets that had stabilized. I think a good, favorable alternative to CMBS, as we were talking CMBS earlier. You don't have to sell your soul with defeasance and other exit costs as much. I think your exit fees are much more reasonable. What kind of a sense can you give us on exit fees on a stabilized asset that you finance?
So our floating rate prepays are 2%, 1%, and then they're gone from that point. And then typically on a fixed rate deal, we may do a 3-2-1-1-1. And in some instances, for some of our bigger clients, we will waive a prepay in the event of a sale to a third party if it's just not a true refinance from another institution. So we have a decent amount of flexibility around that.
John, what's your prepay on exit look like?
About the same. We have we referenced earlier the burn-offs of our guarantees. And so at average life of almost 24 months, at that point, we're at about a point to 2 to exit. And so that's the natural progression is to come into a specialty lender like us that'll take the risk at a bit, well, I say more expensive pricing. You know, I don't know what that's based off of if nobody else is doing it. But the takeout from wells was very efficient, and then we recognized, and our client shared some of those metrics with us, that it was far less expensive on the exit, even though a bit more expensive than CMBS rate. It gave the flexibility to that borrower to sell the asset later down the road.
Yeah, back to what's the business plan for the asset and find the right financing. Turning to our topic of refinancing versus selling in the current market, I'd be first, Arvind, if you could give us a view of where do you think we are in the cycle right now here? Where's Morgan Stanley's view of that? Because I think that really impacts your decision here. So.
Yeah, look, I mean, I think we're late in the cycle, is the short answer, okay? But, you know, you could say that a year ago, you said that 2 years ago. And look, I think real estate and hospitality in general is so location specific, so market specific. And I mean, I'll tell you the first question that Scott had mentioned this, that you ask in credit committee about hotels is new competition. And so the irony is that you can have a hot market like an Atlanta or a Denver or a Nashville, okay, which we've done a couple of hotels in, and you know, in a market that's hot, there's obviously more development taking place. So in a weird way, you know, you want a market that's strong, but not so strong that it brings new competitors in, if that makes sense. You know, it's kind of ironic. But look, we're lending. The economy is, you know, we feel pretty good about where the economy is, and it depends obviously what happens, through the course of the political process going forward, as they talked on the previous panel. But we feel like the next year and a half should be really good, and rates we feel are going to actually decrease even further than where they've come.
So what's the economist's view of Morgan Stanley?
Economist's view is that they're projecting, I looked this up because I knew this was going to be a question, that we're expecting that at the firm level, the 10-year to go down another 15, 20 basis points over the course of the year.
Okay, so it's even going to get more compelling
So,
as long as obviously it depends where spreads go too.
Yeah,
right?
exactly. And that's the other comment, is that a lot of times what happens is that, because again, I mean, people can complain about defeasance, but we're selling bonds to investors that and they need, it's for asset liability management. And sometimes what happens is when the index goes down, the spreads get widened, but that isn't happening right now. Actually, what's unique right now in this current last 30, 60 days is that even with the index decreasing, spreads are decreasing as well too. So the overall coupons are decreasing, and that's just a function of people looking for assets, for good quality assets to buy.
All right, so Adi, how do you think about refinancing versus selling in the current marketplace for your assets?
Yeah, I think to Arvind's point, certainly the spreads have come in, and it's a good viewpoint that despite the base index kind of moving up, the banks are kind of taking the spread on their side of it, and not, the borrowers are not seeing the price creep, and it certainly seems like that trend is going to continue on for the near term, at least over the next year or so. From a financing versus sale, I mean, certainly it's a very individual deal specific, right? I mean, it's where do you get engaged with when you get the deal going. For us, we're set up as a closed-ended fund. So it's you invest over the couple of years, create the yield on the value add side, and exit 2 to 3 years after that. I mean, so that on that vehicle, it's very rarely that we are truly contemplating a long-term refi, because on the onset we're already putting a debt that's 3 to 5 years with extension, so it should not come into play from a timeline standpoint. And we've certainly borrowed right, so it's not a rate specific need for refi. So in that vehicle, it's very rare that we would truly look for a refi. But we've done it in the past. When there's when the downturn's coming and things like that, where it's a unintended need more than the true cash out vehicle, we'll likely prefer to sell over refi if all things are equal. But that said, I mean, I think at this point where we are late cycle, anything you do, you want to find a way to have option pricing. I mean, whatever you do, find yourselves the flexibility. There's available capital out there, so it's people will match your terms for a good deal. So find yourself to have some flexibility on the back end, so you're there to adjust as needed. So.
Yeah, Mark, it's interesting. We're seeing markets go to property through obviously the sales side, and if they're not getting the price they want, they're effectively selling it to themselves because the refi market is so strong. So they're able to cash out, their equity still on the asset and put it on a long-term coupon.
Okay, and turning in terms of the whole refinance market here and the issues from a macro perspective, you got Brexit, is the UK leaving or not leaving? You've got the government shutdown earlier in this year. You've got the China-US negotiations on trade. Has any of this noise been impacting the debt markets?
We haven't seen it. I mean, the debt markets are still robust. I mean, all those are big events that everybody kind of has their eye on. The economy, certainly the global economy has slowed a little bit more than the U.S. economy has, and with the Fed, announcing they're not going to raise rates this year. I think, from a lender standpoint, it's we all want to do good deals, but I haven't seen, any sort of a change in a kind of an underwriting mindset at this point.
John, how about your thoughts on that?
I concur with Scott. We've not seen any. As a matter of fact, we've cut back on our marketing and public relations budget because everybody is seeing as much business as they want. And we don't find ourselves in our niche in a reverse auction pricing methodology, if you will. And we simply stress when we're analyzing during our risk management analysis, we'll add 200 basis points stress to the underwriting and reduce the amortization from 25 to 20 years as just a footnote really in our underwriting memos to gauge any fluctuation in the markets. And the only negative impact we had 18 months ago, roughly in that range, was the reality or perception that rates were going to continue to push. And we had about 125 prepayments that we had not budgeted for that were not about an 8 to 12 month versus a 24 month range. That's important. I keep referencing that because in our private equity model, obviously the shorter term is going to drive our return on equity. We don't want to be in the transaction up to 5 years, whereas banks like to have those assets be a little bit more sticky on their balance sheet typically. But we had, it was an example of the activity in the markets being very robust, that we had that many clients that were able to pay a point or two of exit fee to us and migrating to fixed rate long-term traditional financing over the course of the past 18 months. That was the impact we felt as far as rate volatility or not.
Okay, Addy, how about you in terms of all this macro? Has that impacted cap rates that you're seeing in the market right now and your exits or your buys here?
Yeah, I think, listen, when we talk about cap rates, unfortunately, sometimes it feels like a schizophrenic conversation for us. It's like you have to ask the question in context. You're asking it on the buy side or the sell side at any given point in cycle or the day. So we have a pretty healthy dialogue on cap rates. But I think over the last year, just there's so much equity capital out there, and certainly debt capital out there. And 2018 was a pleasant surprise from where the year before, where the prognosticators expected it to be. It was kind of ahead of schedule, and 19 is kind of still robust. So the cap rates, clearly the haves and have-nots always applies, but in good quality brands and markets, the cap rates have not compressed. Obviously the rates have held up as well, and people have been waiting for the ninth inning, 10th inning conversations for at least a couple of years now. So they're ready. They've been thinking about it. The mindset's there. So the cap rates have been adjusted for that, at least for the past near term, and has not changed much. I don't see that meaningfully changing, at least this year at this point.
Okay, and then another question for you, Scott. Just in terms of the macro new supply, we've been seeing roughly around the 2% level overall, which is very close to historical norms here. How do you guys underwrite new supply when you're looking at a loan here, and if any of these factors come into your underwriting?
Yeah, so in the hospitality space, the data, you can buy really good data. And we obviously subscribe to Star and Lodging Econometrics. So, you know, on a monthly basis, we get a report that shows like every hotel that's either in pre-planning, planning, construction. So we have a very, very clear lens of everything that's potentially coming into a marketplace. And we will assess whether or not those brands will compete head-to-head with our, so if we have a Residence Inn in the market, a JW is really not going to be a direct competitor with that type. So, you know, we'll assess the brands that are coming in, how competitive they are to our property, our comp set, you know, and what we think that's going to do to kind of overall growth in that market. So it's important, I think, both from a lender and an operator standpoint to really have your arms around that information.
Okay.
I think talking about the supply stats, right? I mean, that's obviously the interest rates were one of the, you know, cost creep on the operating side. You know, interest rates were the other side that were likely going to push the pricing. That's kind of stabilized outside of the, you know, towards the end of last year where it was crazy up and down, but it seems to have stabilized and held itself. Then you know, you start thinking about supply, and to the extent in terms of, if you look at any of it, whether it's Lodging Econometrics or Star or any of these data providers, there's a healthy pipeline. I mean, every market, there's not a market that you're going to see that does not have a decent or higher supply expectation coming. So, but our view is just based on where just construction costs have been, and just terms of availability of labor and and the cost creep. If you're not already in the ground right now moving dirt, you're kind of in this late cycle phase where our belief is that there's a good number of them that are going to kind of get shelved for the next cycle likely. But that's not reflective. I mean, from a positive side, we don't believe it's really reflective in a lot of this data providers at this point.
And you talk about pipelines. I was speaking with Eric Jacobs the other day. At Marriott, I believe he said roughly 1,500 projects that he has approved, and vast majority shovel ready, permitted, ready to go. So it's very robust, and we like to hear that.
Yeah, we signed the most deals last year that we did
I'm
since
sure
the last downturn as well.
IHG has a very similar robust pipeline.
Yeah, just a question I get from time to time from our owners is, I'm going to refinance, but I've got some quotes, I'm short proceeds here. Maybe, Arvind, if you could talk about the mezz loan market right now. How do owners fill that gap if they can't get enough senior loan proceeds?
I mean, clearly the most efficient way is to max out the senior as much as possible. And, you know, and that's something else I'd say that's happened now versus 18 months ago. We're able to become more and more aggressive and price it out. But look, I think mezz investors are, you know, they're having the same concerns, you know, where we are in the cycle. I mean, there is appetite, but there's a premium. You know, if an office mezz loan equivalent to 7%, hospitality is probably a 200 basis points premium. It's like 9%, I'd say. And I'd also say that generally speaking, they're more oriented towards size. We have a dedicated 5-person mezz desk that buys trades desks, you know, trades mezz, and then we did $3 billion of mezz last year, and ticket sizes are generally larger. They're not. I mean, there's a limited, you know, demand for a, you know, $40 million or $20 million loan, $2 million, you know, mezz. I'd say it's. You know,
so what's the minimum size mezz that really would get an interest?
I mean, you can do $2 million. I'm just saying it's a cost prohibitive. I think realistically, kind of $5 million mezz, because, you know, with the documentation and with everything's involved. And
so John, I think you do some mezz and prefer.
Yeah, we do. We'll range from $1 million upwards to typically 25 per project, and the rates that I talked about before, somewhere in the 10 to 12 range, which is going to be less expensive than the traditional pricing on the street that you would find for the mezz piece. And so that's where we're more competitive than the senior. And so that's our pitch, is a blended rate to come in at a competitive. But we are and have seen tremendous performance of our portfolio. The only anomaly, if you want to call it that we've seen is we've had, since 2012, about 15 defaults, which is not a big number. We've originated almost 800 loans, and those defaults are not write-offs. They're just simply in a delinquency state, 30, 60 days past due, and they all just happen to be first-time clients. And that's very unfortunate because we have a very fluid delivery to our repeat clients, and every one of those transactions were first-time borrowers, and almost every one of them involved bad boy behavior. And that's not to be sexist, that's just a legal term typically used, of course.
So, Scott, do you allow mezz money behind your senior loans?
We typically not. I mean, we did a big syndicated deal that had a mezz piece behind of it, and we were fine. It was an institutional borrower, but our typical, called a Residence Center, Courtyard, or Holiday Express, or Hampton Network Financing, typically our borrowers aren't seeking mezz piece behind it.
Okay, and how about you, Addie? Do you use mezz or preferred in any of your deals?
Thou shalt not speak about mezz as a borrower from our side, but no, I think, listen, we don't use it. We're in a fortunate place, and from a leverage standpoint, we cap out on individual assets at 65%. So the market's out there. It's kind of middle of the fairway at this point, so the need is not there. From our income side, as we do provide a pref equity side of it, we do have the ability to provide mezz, but we haven't done it. I think our viewpoint is if you're going to get into the capital stack, we'll likely be on the pref equity side.
Okay, so we're out of time right now, so I would like to first thank our panelists for all your insightful comments today, so thank you very much. I'd like to thank the Hunters as well for putting on a very nice conference. Thank you for all attending today, and look forward to the rest of the conference. Thank you.